Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question from the topic non-current assets. In this question, you will learn to interpret the asset account and the relevant accumulated depreciation account. You will also identify the correct depreciation method used and capture the relevant depreciation rate. Lastly, we'll discuss the accounting theory which justifies the recording of any depreciation expense that we incur. You can see the question on the left-hand side of your screen, and on the right-hand side, we've got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Really Just Cars Limited is a business that manufactures motor vehicle parts. The following are the accounts relevant to the business's machineries. So we are given the ledger account for the asset at cost, and then we're given the ledger account for the accumulated depreciation. So the ledger account, as you can see, is prepared using the usual 5-column format that we're used to, with date being in the first column, followed by the cross-reference of accounts in the particulars column. Then we have got separate columns for debit and credit amounts, and lastly, a final balance column. All right. The business estimates that machineries have a useful life of 5 years and charge a full year of depreciation for its non-current assets in the year of purchase. The requirement in Part A is to interpret the entries on those given dates. So let's start with the first date, which is 1 January 2020. So on the 1st of Jan 2020, which is in the asset at cost account, as you can see I'm highlighting here in the machinery account, what does this entry tell us? So on the 1st of Jan 2020, the business purchased a machinery which costed the business $30,000, and the business purchased it using check or funds available in the cashiered bank account. So you could simply write on the 1st of Jan 2020, Really Just Cars Limited bought a new machinery that costed $30,000, and this machinery was paid for using funds available in the cashiered bank account. All right. So what about the second date, which is the 1st of July 2021? Now the 1st of July 2021 is again within the asset at cost account, which is the machinery account, and you can see on the 1st of July 2021, the business bought a new machinery for $20,000, but this time the business financed the purchase by borrowing from Jet Finance. All right. So that is what we're going to simply write, that on the 1st of July 2021, the business financed the purchase of new machinery that costed $20,000, and this loan was taken from Jet Finance. All right. So we need to be as clear as possible and making sure that we have discussed the method of payment, the exact day we have bought it, what's the item we have bought it, and how we bought the item. For instance, in the first one that we have done, we bought the asset using funds available in the bank account, which we're clearly specifying. And that's what you have to do again here on the 1st of July 2021. We're buying an asset again, but clearly we're specifying that we have bought this by taking a loan from Jet Finance. So as long as you mention the specific points, you should get full marks. All right. So what about the next date, which is 31st of December 2021? All right. So on the 31st of December 2021, which is only given in the accumulated depreciation of machinery account, 31st of December 2021, we can see that depreciation expense for the year ending 31 December 2021 is $10,000, and that is what is recorded here. So that is what you just simply state. So for the year ended 31 December 2021, the business incurred depreciation expense of $6,000 specific to those 12 months starting 1 Jan 2021 and ending 31 December 2021. And that is what is being recorded in the accumulated depreciation of machinery account at 31 December 2021 here. All right. So let's look into Part B. State the method of depreciation used by the business and then provide an explanation for your answer. All right. So based on the two ledger accounts that are given to us, we understand that the financial year starts on 1 Jan 2020 and ends on 31 December 2020. So that's the first year that we're working with. And the cost of the asset that we had initially is $30,000. All right, so you can see here, so in 1 Jan 2020, we had an asset of $30,000. And in that financial year, we didn't buy any other assets. So for the financial year ending 31 December 2020, the depreciation expense that we can capture from the relevant accumulated depreciation account is $6,000. All right. So given that we know the depreciation expense of $6,000 for this specific asset, which we bought for $30,000, we can easily find the depreciation rate by dividing the depreciation expense with the cost of the asset. So 6,000 divided by 30,000, and that is 20%. All right. Now, what about the next financial year, which starts on 1 Jan 2021 and ends on 31 December 2021? So in this next financial year, we can clearly identify from the asset at cost account that on the 1st of July 2021, we bought a new asset by financing it using a loan from Jet Finance, and that asset had a cost of $20,000, right? And based on this paragraph that is given here, we know that we are to apply a full years of depreciation in the year of purchase. Also, it clearly mentions that the business has a useful life of 5 years. So when it says that the business has a useful life of 5 years and that it charges a full year of depreciation in the year of purchase, we could say that the 5 years here refers to the 20% depreciation rate, because every year if you have 20% that is being consumed in terms of benefits, then what will end up happening is that 20 plus 20 plus 20 plus 20 plus 20 over 5 years would make it eventually 100% of the values that have been consumed, right? So in this second financial year on 1 Jan 2021 and ending 31 December 2021, we know we bought a new asset of $20,000 and we are to apply a full depreciation. So regardless of whether you take 20% of 5 years, it would give you the same result. So 20% of 20 grand is 4,000. And if you were to find it by simply taking $20,000 and then dividing it with 5 years, you would still get 4,000. All right. So that is the depreciation we have captured for the new asset. Now, what about the old asset? So the old asset, we haven't sold it yet. Nowhere in the question it specifies that we have disposed or sold any asset. So we obviously know that the original cost of the old asset, which is $30,000, in the second year starting 1 Jan 2021 and ending 31 December 2021, we would be depreciating it fully at 20% and multiplying it with the original cost of 30 grand, which would give us $6,000. This validates that we're working with the straight line method. And you can see that the useful life of 5 years, which can be evenly distributed as 20% over each of the 5 years, would ultimately add up to be 100. So this is a straight line method that also we have just proved based on the results that we have derived that we're also working with the straight line method. How? So if you want to find the total depreciation expense for the second financial year, which would start on 1 Jan 2021 and end on 31 December 2021, you have got $4,000 for the new asset and then an additional $6,000 for the old asset, which we bought in the previous financial year, being depreciated at the same rate and also therefore having the same depreciation expense amount. So altogether that gives us $10,000, which clearly validates what is given here in the accumulated depreciation of machinery account at 31 December 2021 for the depreciation expense for that relevant year that we have recorded. All right. So therefore, we can clearly and confidently say that we have a straight line method. Now, what about part C? Define depreciation. So the simple definition, which will obviously give you full marks if you write it in your exams, is to say that depreciation is the allocation of the cost of a non-current asset over its useful life. But we are business students and we want to understand this from a real perspective as well. You could also think of depreciation as an expense which we incur through the consumption of economic benefits that originally comes with the purchase of the non-current asset, right? Because when we buy a non-current asset, the ultimate purpose of buying a non-current asset is to help the business generate more revenue, all right? So in this case, for instance, you're working with a business that manufactures motor vehicle parts, and the machinery, let's just say, that is for installation within the factory so that it can speed up the process of production for this business, right? So this machinery is out there to help the business generate more revenue and add more value to its customers, all right? So obviously, as this machinery, they get used up within the business, there is a consumption of economic benefits that originally arrived with the purchase of this non-current assets. And ultimately, as it gets used, from one year to the next, we are generating revenue through this consumption, okay? So you could also write depreciation expenses incurred through the consumption of economic benefits within the asset to help the business generate more revenue throughout its useful life, okay? All right, so part D, state two causes of depreciation, pretty straightforward. As we use the asset and consume all its economic benefit, it goes through wear and tear, all right? And then you can also think of obsolescence, which is mainly what we expect with technological items, that they get outdated very fast. So, for instance, an iPhone, what iPhone do we have now? iPhone 17, right? So maybe 10 years from now, you wouldn't want to use the iPhone 17 because it would be obsolete by then in terms of technological advancements that would have already appeared, all right? Now, what about part E? State and explain, using a relevant accounting theory, why a business should charge depreciation on its non-current assets. So this is what we classify in this case as the prudence theory, which is most important, because prudence theory simply says that do not overstate assets, do not overstate profits, do not understate your liabilities, and do not understate your expenses. All right? So in this case, where we are working with the cost of the asset and the depreciation expense, we could say that the prudence theory states not to overstate assets or the cost of the asset or the net book value of the asset that we report in the balance sheet, and also not to understate expenses when it comes to profit calculation. Now, we obviously understand depreciation expense is incurred through the consumption of economic benefits that arrive within the asset to help the business generate more revenue. And as this asset gets used up, if we do not record this consumption separately, the fact that we have already consumed this value, we would be not recording our expenses properly. So therefore, we must make sure that we do not violate the prudence theory and always make sure whatever assets are being used in the business, and as these assets get used up within the business, they go through wear and tear, obsolescence, and what ends up happening is that they lose value, and that value that they lose is stored in a separate account, which is the depreciation account, all right? And when you prepare the balance sheet and you report the net book value for these assets, you also want to make sure that those net book values are not overstated and they're representative of the depreciation expense or the consumption that the business has already incurred to help the business generate more revenue. So you just simply talk about the prudence theory and then mention the two main points in the prudence theory, which is to not overstate assets and not to understate expenses. And then you use the sentences that I've used in terms of how this works out in the sense of not overstating the cost value of the asset and not understating the expense value of the consumption, okay? So that's what will get you full marks, simply. All right. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel, and also share this with your friends. You can also check many other videos which I've uploaded on the specific topic for non-current assets and depreciation and sale of assets, and you will find value. So with that being said, I'll stop today's lesson and I'll see you in the next one.